Friends, the topic of this podcast is getting behavior right. Since 2018, there is one thing that is a cause of continuing concern. That is, most individual investors are continuously engaging in trend chasing. And trend chasing today is a huge herd. It's not just a few people following a few people. It's a huge number of people trying to identify and spot trends. And it is not difficult anymore to spot trends because trends are being created to catch you. Instead of you catching the trend is catching you. It's like fish falling into the net. In 2018, it was in midcaps and in small caps. In 2019, it was in financials. In 2020, it is in FMCG and speciality chemicals. None of these spaces are new to me or to people who have been in the market long enough. We have played all these spaces at different points in time and have been lucky with them. And when we see people taking very high risks over and above what we took, and these are people who are just catching a name in thin air or something from a television channel or something from vernacular TV, business TV, it's very evident that people are trying to oversimplify the process of investment ideation. And in doing so, you are catching the trend late. Trend chasing is always dangerous because if you are late, you are going to be sorry. If you see what has gone wrong between 2018 and 2020, that is just before COVID, most people were late to the trend. And not only were they late to the trend, they were giving their capital to the trend without even having diversification, and they were giving it at a speed which is scary. And that is why when the fall happened due to the most unexpected reasons like COVID, the impact has been spectacular. Trend chasing also worked during COVID, either people going out of equity in a hurry when the markets kept falling day after day for a fortnight, or people now trying to get in mindlessly. There is a clear disconnect in investor behavior from the economic realities. I am not against people making the most out of a trend. All of us are products of profiting from the trend. But what helped us in this exercise is behavior. How? Very simple is that the reason I am going to say this is that unless you understand this, you are not going to do the right things. If you want to really benefit from a trend, you must always be ahead of the trend. So you start before everybody else. So if we did financials, we started it long before financials became fashionable. We looked at financials and FMCG at a time when infra was in vogue. And then when we saw that some of the themes that we originally liked came into becoming massive trends, we would like to walk away from that and look at gold. Now today, we are looking at something else. Even exiting a trend like an FMCG or a mid cap has to be ahead. You leave when the valuations have matured. Probably there may be a blowout after you leave, but you always ensure that you leave to safety and don't participate in that part of the trend which can lead to a collapse. Most investors who have entered the markets in the last 5 years have unfailingly participated in the trends of 18, 19 and 20 and taken the hit of collapse. But this has not stopped them from chasing the next trend, which means that you are moving towards multiple failures. And people are doing the investing themselves seem to be doing this repeatedly. This is not a healthy thing because the economy is first going to go down this year. And in the next financial year, 21-22, it will probably regain what it lost in this financial year. And that's the best case. and hopefully we will return to growth in the year after, which is financial year 22-23. So we are clearly looking at 2 years and 9 months in terms of financial years. It's a very long duration, so the trend certainly won't sustain for such a long time, and it will change, it will morph. The only thing that is in favor of the trend at the moment is liquidity, and when liquidity battles fundamentals, eventually fundamentals win. So the question is whether you are going to do trend chasing at the most difficult time, in the most difficult space, with the most difficultly earned income, taking the risks which are not worth taking. It's a personal choice. From what I see, a lot of people are doing it individually and they won't even be able to blame others. And this essentially is a trait of behavior which I have noticed for the last 30 years in people who failed in equity investing. Be it the Harshad Mehta scam of 1992, or the Ketan Parikh years of 2000, or the infra bubble of 2008, or the present bubble in multiple spaces. It's always people who did this without thinking of the consequences who suffered for their behavior. And as somebody who has been in the market long enough, I would hope that people realize what this is and use this liquidity driven rally to lower their risks, to not chase the trends of the past, to identify some future trends which will play out in this 3-year window, and gradually move towards building your positions to favor that trend. Probably when the trend of 2022-23 becomes real, you will not see many of the current favorites performing as well as they are doing now in the stock market. So essentially this responsibility of getting the behavior right is with each individual investor, especially those who do it themselves. Those who get advised must understand whether the advisor is taking them into the future or soaking them in the present. If you are getting soaked in the present or in the past, then you have cause for concern and you should ask your advisor to move you forward. Life is about going forward, economics is about moving forward, growth is about moving forward, and even recessions are about moving forward. As we are in the middle of a recession, we need to move our thinking ahead, and that essentially is the biggest challenge of getting our behavior right. I hope each of you who has watched this video takes these observations in the right spirit and makes the most out of it. Happy investing and wish you all the best.